Hello, hello. I'm very excited to close out the day with this next panel. I think it's a very important panel right now. I don't think we would have been having the same conversation, let's say, last year. But I want to first go around and have you guys introduce yourselves and give a little bit of background into, why you're up here and kind of set the tone of our conversation. Chuck, do you want to take it away?
Sure. So, hi, it's great to be here. So I'm Chuck Mounts. I'm the Chief DeFi Officer at S&P Global. And so my team's mandate within the organization is to help the company build the products and services that are relevant for digital asset markets. And so what we're looking to do is leverage our historical expertise in data analytics and benchmarks and bring it into the crypto ecosystem. And looking to leverage our analytic capabilities and benchmarks to improve liquidity in the marketplace, to enhance transparency and enable decision making, and to foster greater price discovery. So we have a lot of developments that have happened at the company over the last several years, including our initial product in the risk assessment category, the stablecoin stability assessment that we launched almost 2 years ago that measures the risk of a stablecoin depegging from its intended one-to-one mark against a fiat currency. And in fact, you may have seen today, we had a very exciting announcement where we are taking our stablecoin scores and putting them on chain through our partnership with Chainlink on the base blockchain. So this is a very exciting development for us, and the first step we have in taking our risk assessments and putting them directly on chain. We also have many products on benchmark side with the index business, and you may have seen just last week we announced our digital asset top 50, which is looking at creating an index product that captures the broader crypto ecosystem. So those are just a couple of the examples that we're developing to try to facilitate the kind of leveraging our brand and our franchise and our analytics and benchmarks to kind of accelerate the development and adoption in the crypto ecosystem.
Hey everybody, my name is Thomas Chen. I'm the CEO of Function. I'll start with a quick story. So my background, I was global head of sales at BitGo for about 7 years. And the one problem that I saw was BitGo had amassed, and this is all public, about 100 billion in AUC last year. A lot of that was just BTC doing absolutely nothing. So the problem was, how do we turn BTC from this idle, passive store of value asset into a productive, active, yield-generating capital, right? That's what we're here to solve at Function. Currently, we've got about 1.6 billion in TVL, and we're creating high-integrity Bitcoin yield markets.
Hey everyone, nice to be here. My name's James Smith. I'm one of the founders of Elliptic and the Chief Strategy Officer. We founded Elliptic in 2013, and Elliptic is the risk data layer for digital assets. So we work with the leading banks, exchanges, payments companies, asset managers, and so on, to give them the data they need so they can understand both who and what they should be comfortable transacting with online. So that will often be their compliance teams using our products to do onboarding, to understand counterparty, to screen transactions, do the ongoing monitoring, to assess protocols, to assess blockchains, networks, and so on. Looking at the data and the insight that we're able to surface to them about the risks that they may be exposed to and how they can mitigate those risks.
I think before we really dig into institutions coming to DeFi, one of the topics that I think we kind of have to hit on is Friday, right? And the way I want to phrase this question, and Thomas, I want to shoot it to you first, is does an event like Friday have an impact on institutions being interested in DeFi at all?
Does it have an impact? I think maybe I can reframe that, and is what did Friday show institutions about DeFi? Right, what's the story that it told? I think Friday showed a fundamental divide between retail speculation and institutional investment management. I think that in an event such as Friday, where there's a lot of liquidations, retail gets liquidated, institutions post margin and properly risk manage, right? I think that as the DeFi ecosystem continues to develop, it's catering itself to institutional needs. But I think there's the overwhelming risks that it exposed, which is a smart contract is not going to give you a margin call. Like, it's not going to physically call you, right? A smart contract will just execute. So it really depends on how quickly you can post collateral to the dApp, to the specific chain that you're borrowing from, right? And these high throughput chains that are marketed, all these L2s, are only as good as how quickly you can actually deploy in a moment of need, like we saw on Friday. So I think it exposed a lot of different parts of DeFi that still need work, but I don't think it's a DeFi problem per se. I think it's a risk management consideration.
Yeah, I think I agree with that, and I think it showed the importance of having good real-time data, understanding what's happening, and being able to, as you say, react quickly, post your margin if that's your decision. I think it was interesting to look as well at the sort of split between centralized and decentralized protocols in that sort of 2-hour window around the event. We saw the amount of money flowing into and out of centralized venues tripled, whereas decentralized venues, it doubled, not much more than that. So I think it highlighted that the sort of the safe and the quick way in most people's minds at the moment is still to head back to a centralized venue.
You know, I guess I would add to that, being in a TradFi firm, I would say that it will definitely be a point of conversation amongst executives and leadership teams who are looking at building the space. But it's probably just that, a conversation with the recognition that there's a combination of macro and idiosyncratic risks that come along, and really just heightening the, okay, if this is the backdrop, how do we kind of engage in the space? Both from a product perspective, but also from a reputational risk perspective. I don't think that stops advancement. I just think it'll be part of the conversation. And I would also argue that events like last week demonstrate the need or the opportunity for a firm like S&P to leverage our trusted brand and data risk and analytics to bring to the marketplace and shine a light on some of the risks inherent in the ecosystem. So once again, I go back to our stablecoin stability assessments that we provide. We have 10 SSAs in the marketplace that are scored on a range of 1 to 5, 1 being the best and 5 being the worst. There are no stablecoins that score a 1 today, and there are 2 that score a 5. Athena is one of those that is scored a 5. And if you look at the risk assessment write-up, it talks about the complexity of the operating model of the coin and the reliance on external parties. So once again, I think this is an opportunity where firms like ours with a trusted brand and deep analytic capabilities and understanding can help shine a light to market participants on what are some of the risks that are inherent in the different kinds of stablecoins or the different kind of products that we actually do a rating on. So we have several ratings in the marketplace, including a rating that was made public a few weeks ago around the Sky protocol. So once again, we are striving to provide that transparency and insight to market makers to inform their decision making that then in turn leads to enhanced liquidity and better price discovery.
If I may add one more per point of view per se. So let me put on my retail hat and then let me put on my institutional hat. So having been at BitGo, we were called Trad Crypto, right? Which is, I don't know if I'm crypto native or I'm TradFi, but a retail person in crypto, kind of this crypto game, you really just want leverage and you want yield. So if I'm a retail person, if you look at my user journey, I'm hearing about stuff on crypto Twitter. I see the yield. These KOLs that I follow are shilling it. Sounds great. Athena or any of these protocols, like, do they have a Lindy effect? Have I heard of it? Sounds safe. Are my friends in it? Great. I'm just going to figure out how to get access to it, right? I'm savvy enough to get access. Compare and contrast that with an institution. The way the institutions evaluate it is, okay, where are the keys held for the dApp, right? If my assets are going in there, what is the actual control security mechanism? Okay, what is the, for this specific trade, what is the LTV if it's a borrowing strategy? And then for the dApp in question or wherever trade you're going, like, what is the liquidity on that venue? What happens in a moment of liquidity crisis? all of that is mapped out. So they do tend to move a lot slower and more carefully. For us, we usually employ mostly market neutral strategies, so we weren't affected by this at all. And in fact, a lot of our strategies profited from the market dislocation.
I want to zoom a little bit further out. When I was introducing this panel, I made kind of like a snide comment that, we might not have had this exact panel last year. And I want to use that as a jumping off point for a question, and I'm curious to get your take first, James. How has the conversation around institutions entering DeFi changed in the last 2 years?
Well, I think there's three major things that have changed. I think it's rules, it's rails, and it's data. I think it's the first one has been talked about a lot, but both in North America and in Europe, we now have frameworks that didn't exist before. We've got Genius in the US, and hopefully at some point Clarity. We have Mika in Europe, which is now in action, and these really changed regulation from where it used to be a couple of years ago, even fairly narrowly focused on just anti-money laundering. Now to bring in other aspects of markets and consumer protection and various other agencies coming in and thinking about how they're going to make this a safe space. And so having those more general frameworks gives comfort to institutions to say, okay, I can start to understand how I can play a role in this ecosystem. So I think that's really important. Rails, infrastructure, right? Like the level, the sophistication of custody, of exchanges, of bridges to get between networks, of the DeFi venues, of liquidity pools, and so on, has come so far in 2 years. Has been battle tested. Has been battle tested by bad actors in many places, and has become more resilient as a result. And so we are in a better place to be able to assess the relative risk of different parts of the ecosystem. How can I get comfortable with a centralized venue? How can I get comfortable with a decentralized exchange? How do I compare that to different types of decentralized protocols? And then finally, I think data is a critical piece. Most institutions are not going to come and start doing anything unless they can understand, they can report, they can monitor, they can be audited, they can explain to their board what's going on. So it's so critical to have both the market data to be able to understand the world that you're wandering into, and then also the risk data to understand who you're trading with, particularly in the decentralized world. And so I think the maturation of data platforms like yours, like ours, to be able to give people the data they need to understand across every chain that they want to interact on, as money moves from one chain to another, to be able to see through all of that and to be able to really understand the various types of risk that they need is the third and most critical piece, I think, that has changed in the last couple of years.
Thomas, as you said, you worked in trad crypto, and that's kind of like an interesting combination of the two. And I'm wondering, from your experience, what can both the institutional players and the more crypto native crowd learn from each other as we start to see these paths converge?
I think at the end of the day, it's all about liquidity. As James mentioned, right, during the crisis on Friday, people flock to where there's liquidity, right? So I think for institutions, whether it's one chain or other chain, whether it's on chain or off chain, is inconsequential. It's where's liquidity, where's capital efficiency. And so DeFi has made a lot of inroads in building the right infrastructure to be able to cater to institutions, because they know that institutions can bring a lot of liquidity. But right now, I would say the way that I view it is DeFi is like this experimental pool of liquidity that technologists and people are actively building new financial primitives to see how things work. And then every once in a while, it kind of goes off the reservation and does something crazy, right? But it does take time for the rails to mature and evolve and for the institutions to catch up. So if we look at like all the narratives that are pervasive today, I would say stablecoins and Bitcoin are like the foundation, the bedrock of how institutions are going to get into decentralized finance. And then you have some of the more speculative things like perps, right? Or RWAs. And then, of course, it's all about how they can access all of these things. And I think DATS is probably the perfect culmination of a lot of these factors, where DATS, to me, are actually just TradFi wrappers of crypto assets, funnily enough, instead of the reverse, which is what we normally see. So DATS is probably worth focusing on as like the pilot use case for how the two worlds are converging.
I think that comparison to stablecoins is interesting as well, because I forget which year it was that we first had a stablecoin, but it was several years before we had DeFi Summer, certainly. And it's taken until now for us to suddenly start using them properly. Right? It's really not been until this year that the mainstream has come in and started using stablecoins, and they've been banging around in the crypto world for 8 years or so. And so, DeFi is still young by comparison, and we are still in that testing phase, and it's more complex than a stablecoin. So I think there's a bit of testing to be done before it has its stablecoin moment.
I definitely think we're at that point of mainstreaming, going from what you describe as like the experimentation phase, going into tangible, executable applications. And I think the foundation of that, or the bedrock of that, is a combination of acceptance in the ecosystem. And I would say there are two kind of meaningful catalysts in the last year that helped facilitate that. One is the approval by the SEC for spot Bitcoin and Ethereum ETFs. I think that was a pivot point or a catalyst for the sector as a whole. And then the other is for household names in the financial industry like BlackRock, as an example, to become vocal advocates and proponents of the tokenization of everything and the markets operating on blockchain rails. So I think that was a very important backdrop or contextual backdrop for executives and TradFi companies around the world. But as importantly, or I would argue probably even more importantly, is the policy formation that's accelerated, particularly in the United States after the last election, with a new White House and a new Congress, that has gone from being an antagonist to all things crypto to being the world's largest protagonist, with a stated objective of being the crypto capital of the world. That's a fundamental shift in policy approach, and you're seeing that cascade through not only legislation like the Genius Act and the upcoming Clarity Act, but also in the execution of rulemaking and policy, regulatory policy action. So I was just looking at policy actions that have been undertaken in the last month or two by, the FDIC, the OCC, the Fed, the Treasury. There are a number, like a dozen policy actions, regulatory policy actions that are moving forward even without legislation. And so I think the combination of this policy formation in total by the world's largest economy and the world's largest financial market is a game changer for the mainstreaming of the capabilities in the ecosystem, and we're just getting teed up for that, in my opinion, in 2026 and 2027, for that to really come on stream.
So to clarify, you think that we're going to have more institutions really showcasing what they're interested in 2026, 2027?
I think that from the seat we sit in, we see that a lot of organizations have been in this experimentation phase, and looking at products they could create or processes they could create that would be kind of introducing crypto capabilities into their business network, even if it's not launched. And I think we're at that stage where it can move from that experimentation, non-launched phase to actually launching. And there's a lot of dynamics that will play out. Some are idiosyncratic within the organizations themselves. Some are macro in nature. To your first question is, how do the events of last week kind of affect those discussions? But I think in combination, we should expect to see, and I would expect to see, a pretty significant ramping up of capabilities within the traditional market infrastructure.
I saw you raise your mic. Did you want to make a point, Thomas? Okay. I guess when I'm thinking about moving forward from this experimentation phase into the actual institutions really bringing DeFi in, my biggest question is, what are the use cases for them beyond, like, stablecoins make sense, right? DeFi, I think it makes sense, but sometimes it's hard to see why the institutions are eager to be there. And so, Thomas, I wanted to actually ask you, what do you think you're going to start, like, what kind of announcements are we going to start seeing 2026, 2027, for example?
I think there was just an announcement a couple hours ago about BlackRock building its own tokenization platform, if I'm not mistaken, on Twitter. I was going to say crypto Twitter. And with NASDAQ announcing, right, them tokenizing their pipeline of their ecosystem, I think we're seeing these large institutions come in. And again, from my perspective, I don't think the institutions care what chain it's on. I think the institutions are going to have chains, and chains will be used for purposely selected or built for particular use cases. But at the end of the day, as long as there's liquidity, that's ultimately what matters. I don't know if I can predict. I'm not as close to on traditional finance side as Chuck and James might be on what announcements might be coming in. But I think what S&P has done is clear the way and give some more clarity and reassurance for the risk operators at these large financial institutions, funds, to sign off and on these decisions when they go into DeFi, right? If they say, okay, based off what S&P is saying and the risk level scoring of these particular assets is a 1, 2, 3, 4, or 5, I'm comfortable deploying this much, right? So I think that gives the structure and discipline and mature processes that's much needed in this space.
Yeah, I think as you said before, DeFi at the moment is in its testing phase, and I think crypto is a great testing ground for people to try out lending and swapping and everything else. I think that's not going to be adopted at scale by institutions until A, it's robust and we see that it doesn't get hacked by North Korea, and B, that the liquidity is there. And I think the liquidity that they care about is bringing more and more assets on chain. So it is tokenizing more things, and then being able to take advantage of cheaper, atomic, quicker swaps, same lending, et cetera, et cetera. So I think the use cases will be all of the use cases that we see today, but it won't happen until we've got comfortable with tokenizing more assets and comfortable that we've built robust venues.
I might key on a couple of things that Thomas said as well. So I'm not so sure that institutions won't care what chain they're on. I think, like, from our perspective, we're chain agnostic. And so we just want to provide the tools that enable folks to understand the risks that are inherent in different kinds of operating environments, including which chain they're on, that optimizes their business. So I suspect that there will be some differentiation in the future of institutions deciding, kind of based on analysis that some of the firms up here do, and maybe others, to decide where they think they can optimize their focus on liquidity. I agree with that. Get the focus on liquidity against the inherent risks of the operating environment they're choosing to be on. And that's where, once again, we think that we can help firms navigate those balances, or find that balance between maximizing liquidity and operation kind of robustness against the risks that are inherent in different operating environments.
Yeah, I think it's as we think about tokenizing more assets, it's important to remember that they're going to be a lot more complex than moving currency around, and the requirements that come with moving around a bond or a share or something more complex go up. So having the right controls, having the right data visibility, being able to report, all of that needs to be in place before institutions are going to be comfortable making these complex transactions on chain. So as well as the sort of the technical pieces underneath. It's about being able to give that visibility, make sure that they can really understand what they're doing, and they can report to the appropriate people.
You teased your announcement today, the S&P announcement with Chainlink. I want to dig a little bit into broadening that and speaking about the way that we rate or standardize ratings for safety reasons for institutions. When you're thinking about and having these conversations at S&P, what are they centered on? What are you trying to standardize for institutions across the industry?
Well, so just as a point of clarification, so I'm in the strategy function at S&P, so I sit in a commercial function. We have a separate analytic function that has responsibility and ownership of the analytic approaches, and we're separated by a Chinese wall, so they operate quite separately. But for people in the audience who are interested, the lead, our analytic lead in digital assets and crypto is here at the conference, Andrew O'Neill. And I would suggest if you're interested in kind of doing a deeper dive on the analytic approaches that are deployed in the ecosystem, he's a fantastic resource to speak to. But I would say that for the analytic approaches, start at a baseline of our existing methodologies and look at like the fundamental risk tenets that exist in traditional markets that are applicable in a crypto environment. So looking at things like asset quality, operating risk, operating structure, regulatory risk, liquidity management, things of the fundamental nature. That's the starting point. And then from the analytic context, you would kind of jump to the next. Okay, what are the risks that are unique because it is a crypto ecosystem? So, for instance, perhaps the blockchain, or perhaps like any kind of custodial arrangements that may be different in a particular context. What about the usage of a stablecoin, and which stablecoin? So you start with the baseline, then you move into the risks that are more idiosyncratic and specific to crypto, that then form the new analytic approach, and either the rating or, in the case of the stablecoins, a non-rating risk assessment.
I see we only have a few minutes left, and we do have a lot more that I wanted to get to that we just are not going to be able to get to, unfortunately. But I wanted to ask you, Thomas, how do we think about risk versus opportunity in this space?
From an institutional standpoint, or?
Yeah, well, no. I guess from an institutional standpoint, I'm curious to just get your take on when we're seeing these paths converge. What else do they like? What does our audience need to know? Because we've got primarily institutional audience members.
Sure. So I can speak about this from the Bitcoin holder perspective, as that's the majority of my LPs or clients. So from their perspective, BTC normally is just an idle asset, right? And I'll kind of paint this under the guise of what's happening with DATs. I think right now in Q4, the accumulation phase is going to be over. And soon, the treasury managers are going to ask themselves, I've accumulated all this BTC. What can I do with it? How do I deploy it? Just like idle cash is bad, how do I utilize the BTC in order to get more yield to hedge against these, market volatility, et cetera, et cetera. And I think you'll start to see the MNAV be more associated with the operating company and how the team utilizes the BTC versus just, financial engineering to quickly buy as much as possible. From the perspective of how this goes into DeFi, typically what we've seen is generally most institutions have a hurdle rate about 5% that they want to achieve on BTC yield. Now the challenge with BTC is if you really want to get granular, there's several different ways you can generate yield, but there's three main buckets. First one, of course, is trading, whether that's on-chain or off-chain. The second one is lending, which is the one we see most of. Use BTC or a wrapped version of it, like ours, as collateral to borrow stablecoins to run a trade. Or the third one is staking. And if you guys are more crypto native, you'll remember staking Bitcoin is not technically possible because Bitcoin is not a proof of stake chain. But there are different projects that are trying to figure out how to, via a smart contract, delegate BTC to earn some sort of reward. There are different risk profiles to each approach. And one of the things that we're trying to solve for is how do we make it as simple as possible so that institutions can take a look at the different strategies and know that this is classified as a safe strategy or a balanced strategy or an aggressive strategy based off of the underlying infrastructure DeFi applications that is being used to generate those returns. And I think what Chuck and the S&P team have done is break open the door for some standardization from the institutional side. And it's kind of funny because there's no real standardization on the DeFi side, even though DeFi, quote unquote, moves more quickly than TradFi. So I think this will come and a standardization will quickly orient itself to some of the larger players that have amassed a lot of capital within DeFi that are running these strategies.
If I think about the institutions that we work with and how they're thinking about their question of risk versus opportunity, I mean, there are so many things they could do, sitting in front of them. And frankly, 2 years ago, they would have said no to all of them, or most of them did. There were a few early movers. And that's entirely changed now, right? Everybody has got a digital asset strategy now. But I think they're still being selective and looking at maturity, looking at maturity of technology, of a market, amount of liquidity, etc. The biggest banks that we work with are going for perhaps the most obvious thing of sticking to what they know and doing reserve management for stablecoins. There's $300 billion sitting in stablecoins now, and they'd like that to sit at their bank rather than somewhere else. But that in itself comes with a huge set of new risks that they don't understand. So using the right data, making sure they understand how money flows around that ecosystem, what their risks are, who are they exposed to, and who are their counterparties exposed to, and how do they manage all of that. I think starting with the thing that is closest to your core expertise is the obvious thing to do, and that's what most of the biggest banks we work with are doing now.
Okay, we've got 1 minute and 30 seconds left, so I'm going to just have you guys do closing remarks because I know that there's a lot more on this topic that we weren't able to get to, and I want to close out with your thoughts and what you think is next. And so, Chuck, I'm going to start with you.
Yeah, so I think probably the next phase with a backing of policy clarity, particularly once we get the Clarity Act and really defining the regulatory framework and architecture will further unlock the opportunities in the DeFi and the crypto ecosystem and really allow us to move from a point of evolution in the marketplace, i.e. reducing costs and looking at kind of the next extension of distribution to new types of clients, to the revolution in markets, which is like the formation of new pools of capital that are accessible by a wide and new audience set that enables portfolio construction to go to the next level and integrates both on-chain and off-chain capabilities to deliver unique and bespoke risk-return attributes. So I think that's the next stage, and it will be couched in a foundation of the technology advancements and the regulatory environment.
I'll be quick. Again, as I mentioned, the accumulation phase for Bitcoin is over. People are going to have to figure out how to deploy that. Yeah, that's about it.
I think if you haven't got a stablecoin strategy yet, go and get one. I think stablecoins are here for good now, and you can manage the risks. There's good data. You can do what you need to incorporate that into your workflow. I think the tokenization of other assets is the next step, and I think that's really exciting to start seeing. Major players like BlackRock doing that on public chains rather than keeping it all behind doors on sort of enterprise chains, as used to be the case. And I think that those two things, when combined, will start to unlock DeFi and in a major way. And so I'm really excited about that coming to pass.
Well, I think in 40 minutes we were able to chart a little bit of a path forward for institutions and DeFi. So thank you guys so much for joining us.